All right, guys. Good evening, everyone. Thank you very much for coming to class 2. Um, I really appreciate you guys coming over so late in the evening. I would be more than happy to go over our class 2 together. The class 2 is about building a watch list and also finding support and resistance level. I mean, in the class 1, if you guys remember, we discussed about some introduction about the trading, day trading, and brokers, tools, and platforms, and how to set it up and how to actually become ready. But now in this class, we want to talk about what to trade. Okay, how to build a watch list, and when you build a watch list, how to find the support or resistance in there. Just a normal disclaimer that we are not really advisory service. We are not registered with any financial authority, and you should definitely talk to a qualified advisor to see if you're doing trading is good for you or not, because trading is a very individualized career. So you have to make sure that what you do with your money is actually good, because what other people are doing with their money, not necessarily you should do the same thing. We are not really qualified to give anyone advice about directly buying and selling any security. So what is our education? I mean, as I mentioned in the class 1, we discussed about introduction and onboarding, and then in class 2 we talk about building a watch list and finding the trading levels, and we go through the part 1 and part 2. The class 3 we talk about the technicals. Class 4 is about the strategies, and class 5, which in my opinion is the most important class, is about the risk management that you have in our education center. So what we discuss in class, how to build your watch list based on the Gappers scanner. So we do have a Gappers scanner that I'll walk you through all of this one by one, and teach you what we are exactly looking for as day traders before the market opens. And after the market opens, we're looking at finding trading levels, support and resistance level. There are two parts on that. There are some levels, the automatic levels that you can the platform automatically finds it for you. There are 5: yesterday low high, 2 days ago low high, and previous day close. And there are some levels that you as the trader should go and find it, like pre-market levels, moving averages, extreme daily levels, and 52-week low and high, and all-time low and high. And then we'll discuss about what makes a good daily chart for day traders. What makes a daily chart is attractive for day traders. Because sometimes I say in the chat room that I like the daily chart in the pre-market, and people are asking me, okay, what do you see? What makes a daily chart attractive for day traders? If you have any question, feel free to type it in the chat, and we have some of our team answering that. And we make sure that we get to you. And if sometimes I stop, I'm not really able to read the chat and questions and do the presentation, but I'll definitely stop time to time. So let's go with the part 1, how to build a day trading watch list. So we are called retail traders. We are really not institutional traders, because we don't manage other people's money. These are all really our own money. And we have to be really effective with the money that we have. We can't just start trade whatever stock that is in the market. We have to be really careful to what do we trade, because we are looking for the stocks that have enough volatility and movement in the day, so as a day trader we can make money on that. So in this industry, we call them stocks in play. These are usually a stock that has some fresh fundamental catalyst news with them. And these are the news that directly affected the company and its operation on a fundamental basis, like earnings, FDA approval, merger and acquisition, partnership, contract win or loss, restructuring, layoff, or buybacks, debt offering, and these kind of things. This means that there is something big with the company going on, and that causes the stock is gapping up and down. Sometimes there's a lot of news coming out for every company every moment. But there are not really important news. We are looking for news that have actually caused the stock gapping up or down more than 2% with heavy trading volume. And this is just an example of Michael Kors. And as you see, every once in a while there's a news coming out, and then the stock is getting a huge volatility with heavy volume. In the normal days, you really don't want to trade that, because there's not much movement. Do you see, when you look at the candlesticks, there's not really much movement. But when there's a news coming out overnight and the stock is gapping up like that, or sometimes it could be during the day, you see that the range that the stock is being traded is actually significantly higher. So from 42.50 all the way up to 46.25. 75. So that's a big range for trading. That's 4 or 5% range. And that's why the volume is significantly high. In a normal day, you really don't want to trade. You really don't want to trade, when in stock there's no range. These are the moments the computers are moving, causing the stocks gapping up and down. So you really want to stay away from that. So why these? I mean, one of the reasons that you really want to trade these stocks is because these are the stocks that are independent of the market. There are market generally move together. I mean, sectors are moving together. All of the tech companies, all of the biotech companies, all of the retail companies, they're all moving together. But you want to be independent. You don't want to get hit by computers and algorithms and institutional traders. For that, we usually, as day traders, look at some famous ETFs. So, SPY, S&P 500, is one of the most famous ETFs that shows the 500 biggest companies. And QQQ is the NASDAQ 100 index that tracks the first 100 stock in NASDAQ. And by looking at the SPY or by looking at QQQ, you can actually see what the overall market is doing. So in this example, the overall market, in this particular day, the overall market was selling off, and that's why the SPY is selling off. So you can expect, when they say, market is selling off, probably one of the index that they're talking about is a SPY. But does it mean that every stock in the market is selling off? Not necessarily, because in that particular day, back in August 2017, when the market was selling off, we did have a stock that gapped down 8% in the pre-market. So by 8 o'clock in the morning, we had something that gapped down 8%. But during the day, while market was selling off, we had this LB going up. And this is the type of a stock that you want to trade, because this is completely independent from the overall market. And then you can focus on this stock, you can find the patterns in this stock, and you can trade it profitably. But if you just pick a random stock, you might want to go long, but because the SPY market is selling off, you might constantly getting a stopped out, and you have no idea why you're getting a stopped out, because those are the computers that are moving the price of this stock. LB in that particular day in the morning, as you see, gap down 8%. But during the day, actually recovered some of that loss. While the market was really weak in that day, LB in that day was a stock in play. So this is the type of a stock that we are looking for. We don't want to trade something that really tracks with the market. So someone might ask, we always have to ignore the market? You just look at the stocks that gapped up and down and we trade them? The answer to that is not really. Sometimes when the volatility is really high, like the market that right now we are in there in December, November 2018, a market can affect even the stocks in play. Sometimes you think the stock is in play, but because the market is really volatile, your stock in play also can get really choppy. This is the example. This is a daily chart of a SPY for the last few months. And you see up to October, the market was in a very, stable situation. Yes, it was going up, but there was not a lot of volatility. Each of the candlesticks are really small, and slowly just moving up. It means that the market is slowly moving up. And since October, the volume started increasing, and as you see, the volatility of the market started as well. So I look at the size of the candlesticks, and now each candlestick in each day, you have a huge range going up and down. This is what we call the volatile stock right now. So from a very bullish market, all of these crossovers turn over, and now this is the bear territory, and now this is a bear market, and everything is selling off. So in this particular situation right now where the market is, we have this problem that you have to also take a look at the market situation. But generally, this is an extraordinary situation. We don't want to stay in this market for a while. Probably after a few months or a few weeks, market stabilizes, correct itself, and then we'll continue toward a more stable condition. In those times, you can really easily ignore the market if you have a stock in play. But now in these conditions, you probably want to also keep an eye on the SPY, because the market condition can affect your trading as a day trader. But generally speaking, day traders would really, really love this situation, because this is volatility, and the day traders make money from these movements inside there. You don't make a lot of money when the prices doesn't move. You just you want to stay away from it, because you just constantly chopped up and down with computers. Is there any question, guys, at this moment that we can answer? If you want to learn more about, when to look at the SPY as a market, you can also go to our education center. And one of the basic lessons that we have is, just go and watch this video that we discuss about that with examples and everything. This is if you have access to our membership. So what is the method that we are finding the stocks in play? The main way that we find our stocks in play is we're using a Trade Ideas scanner called Gappers. This is the stock that we are in our community build, and it's a very simple. We're looking for the stocks that gapped up 2% or minus 2%. The price range that we are trading mostly in Bearable Traders is from $5 to $250. We really don't trade penny stocks because they're really manipulated and they're really pump and dump in there. And we don't trade very expensive stocks like Amazon, $1,000, $2,000 per share stocks either. So we stick to that range. So average true range is a criteria that we're looking for because we want to have something that at least 50 cents going up and down. You don't want to trade a stock that has only 1 cent movement or 5 cents movement because there is not a lot of volatility. You're looking for something that actually moves. The floats we put in 1 because we just don't want to get ETF. You can remove that, but if you don't put that 1, sometimes you get ETFs in your scanner. We don't trade ETFs, but you can specify the float. If you are, for example, if you don't want to go trading, if you want to go, don't trade very, volatile, low floats, penny stocks, you can just identify, specify. Okay, I want to trade only up to 20 million, minimum 20 million shares float. So those are really stocks that are easier to manage the risk. And for the volume, we're looking for at least 100,000 shares of volume. And this is the volume in the pre-market. So every moment is changing. So the gappers that we have, for example, by 925, this one is constantly changing. So the moment the stock is getting more volume, their new stocks are hitting our scanner. So in this example, for example, you see that, from the 7,000 stock that we have, right now 5 or 6 or 7 or 9 stock in our watch list. So we don't need to really look too much. A stock that has gapped up 45%, or a stock that has gapped down 23%. So we have the whole range of them. And we can actually have a lot of information in there. What's the average through range? So the higher, the better, because we are looking for volatility. And then we also get information about the float. Are they really the same animal? No. I mean, ABIL with a float of less than 1 million share, it's a different animal from the stock that like FTC that has 582 million shares float. And float means the number of the shares available for trading. It's not the volume. It's the total number of shares that company has issued that is potential. It's like supply and demand. But the volume in the pre-market, as you see, these are the numbers that you see. All right, so now imagine we have, so from 7,000, stock, we have 5, 6, 7. What do we do? So here's what we do in our community. We have a morning routine. I mean, at 8:30, usually Carlos starts going through the news and daily chart analysis. By 9:10, I would come and take a look at the watch list and finalize the watch list. And then from 9:15 to 9:30, before the market opens, we look at the daily charts and we come up with a game plan. We work on our if-then statements. And this is finding the daily levels is something that in the second section of the this presentation is that. And then by 9:30 to 9:35, I recommend people to observe the price action. The first few minutes is really volatile. You can't really find any pattern to the upside or to the downside. So I really recommend people observe in the first 5 minutes. I personally, and remember, market opens at 9:30 on the Eastern time zone. I personally recommend wait for 5 minutes. Sometimes I start trading in the first 5. In the last few months, I started trading in the first 5 minutes. Usually after 3 to 4 minutes, and I'm practicing a new strategy for myself. So you might come and say, "Oh, this is hypocrisy." You tell us wait for 5 minutes, and then you trade after minute 3 or 4. But this is something that I'm actually trying to adjust to the new market condition. A lot of traders still believe that you should stay away from market at 5, 10, even 15 minutes to the open until the first huge volatility comes down, and then after that you can actually find good patterns. But I personally always recommended people to wait at least for the first 5 minutes. But as I mentioned, also just a disclaimer to you guys that if you are part of our chat room, you see me that sometimes I trade And most of the time I lose money, but I want to learn because I see there are some nice patterns that you can find in the first 5 minutes. All right, so that's the routine. Well, let's go through that. Okay, what are you looking what are you saying when you're saying reviewing Apper's watch list and finalize? How do you finalize that? That's the next part that we're talking about. So example, we do this every day. An example, like in that day, we had this bunch of stocks, HDGM, STRP, ALR. We have all of this information. And now what we do is we go and review the pre-market activity. We don't need to trade all of them. Not necessarily everything that hits our scanner here is tradable. I mean, it might not be really a tradable. So like for example, ALRR, the price is 49.45 and there are 3.8 million shares float. 3.8 million shares volume, gapped up 17%. But we have to check it out. I mean, see what's going on. Why it's such a heavy volume just by 9 o'clock in the morning? It's really important to go and actually look into that. So what we do is we look at the pre-market and go through each of them one by one. And we look at two things: a good volume and a clean pre-market activity. And I know these are not really obvious words. What do you mean by good volume and clean pre-market activity? It's best to go through the examples. So INCY, for example, if you hit the scanner, you see from 7 o'clock in the morning all the way up before the market opens. When I look at the pre-market activity, I see a decent, uniform price action. Plus a decent volume and decent price action. You see what I see here is there's a low of the pre-market, then there's a movement. It seems that it's holding this moving average. There's a high of pre-market, very clear high of pre-market. So it looks like a very decent pre-market because the candlesticks are kind of uniform all across the time and the volume is kind of decent. So if I want to give it out of 10 a mark, I would probably give this one a 7 or 8 out of 10. So it means that this is what I like. I really like the price action on this. So this probably would make my watch list. So more example, HDGM. This was also in that watch list. So as you see, in the morning, 5, 6 o'clock, start gapping up. And again, a very decent pre-market. I like that. I mean, the pre-market activity, the volume is high. The stock popped up at 780. There's a bounce and comes and stays below the view. This, I would say this is a good price action. I'll give it a 7 out of 10. So I like the price action. So there is potential for the stock to be trading. But ALR was another example. And I come and look at it and see this stock. Look at this price action. It's all flat at 49.50. And with heavy volume, look at the volume. There's nothing until 8 o'clock. At 8 o'clock, there's some heavy volume. This is 8 o'clock usually when the institutional trader starts come and they work. And 3.8 million shares are being traded. And after that, pretty much is nothing. So this is a bad price action. So I would probably give this a 1 out of 10. But I have to check out what is going on. This looks like a buyout. And we'll discuss about that buyout. When the price is flat, there's no range, there's no volatility. And remember, as a day trader, you really want to find these volatilities. And there's heavy volume. That's very interesting. But that is a buyout. The buyouts are usually the confirmed news that one company buys another company. And usually the price is fixed. So Hawk is another example, for example. And that day, January 16, the price comes out that Silver Lake and P2 Capital Partners are going to buy Black Hawks at the price $45.25 per share. So the price is fixed, the news is fixed, and the Hawk is gapping up. And look at it; it's pretty much trading right at $45. There is no range because nobody would buy this at 46, 47 when the price is fixed. Nobody buys or sells lower either because the price is already fixed. So as you see, the stock is being traded exactly at around the range. I mean, 10, 20 cents probably to people who want to cash out earlier because this transaction probably happens a few months later, but that's the news that comes out. So the stock is gapping up, and these are the people who want to get out. And look at the volume, heavy trading volume, and all of that is in the pre-market. We even haven't, the market hasn't opened yet. And these are confirmed news. And price usually flat and heavy volume in the pre-market because that's the moment that at 8 o'clock institutional trader comes in and they start trading the institution to another institution. But sometimes there are some rumor and unconfirmed chatters, and those are the ones that there is potential for trading. So not every buyout is really tradable. The unconfirmed buyout, sometimes they say, Apple maybe buys this company. maybe or maybe not, there is some discussions, then that's a really good opportunity because there's a lot of volatility and uncertainty comes in. But if they issue a press release and they say, okay, we already done the agreement, the investors are okay with that, $45 per share, that's it, then there's nothing really to trade. Yes, it does hit your scanner. Yes, there's a lot of volume, but it's not really tradable because there is no volatility on that. Is this clear for you guys in the class? All right, excellent, nice. So we see these kind of buyouts every single day. So what's a good and bad price action? You know, continuing of those discussions. I mean, CBU again hit the scanner. What we see is stock gapping up. You know, I would say this is a decent price action. I mean, there is some decent volume. It's not crazy. It looks like a low of the pre-market, high of the pre-market. This moving averages is holding as a potential support. I would say probably this one is also a 6 out of 10. So I would definitely consider this one. Westport gapping up, volume is really not great, and it's just chopping up and down. I don't know. I'm not really keen on that. I probably give this one a 4 out of 10. If I don't have anything else, I might watch it. But if I have better options, I would probably look at other stuff. So I would consider this a bad price action. Another example of a bad price action is NSAT. Yeah, it hit your scanner, gapped up 10%, 20%, but look at it. There's nothing. There's no volume. There's only a small amount of volume happening at 8 o'clock, and then after that there's nothing. No transaction, nothing. So even if this one hits my scanner, I really don't see any opportunity in that. So I give it a 2 out of 10 or 3 out of 10. So I definitely don't put this on watch list. Sometimes you have, this is another example. Sometimes you come and see that a stock is gapping up. There are volume, but the price action is really, really ugly. And those are usually the time that you see a block trade. You see this block trade? This is what we call the block trade. This is one transaction between another institution. So someone at Morgan Stanley picks up the phone and then dial someone in Deutsche Bank and say, hey, I have 200,000 shares of PHG at $41. Do you buy it? And say, yes, done. And then the transaction would happen. It goes through the institution to institution. It will go through time and sales because they have to, they have to report that transaction, but it doesn't really go through the market. So that's why it doesn't provide any volatility. It doesn't go through the market. So it's just the direct transactions. So those are the block trades, usually not tradable. This is an example. PHG in that specific day, the volume was really good. Time of the day was 9:15. It was really good. 2% up, decent ATR. The float was great. Everything was great. But and I said, oh, that's great. I come and take a look at this. And yeah, that's pretty decent. But as soon as I checked the price action, I said, damn, that's a block trade. So that's probably not something that tradable. This is an example of a block trade that goes through the time and sells. SPP. I think as you see here, SPV here, again, gap down 9%, 200,000 shares. Look at the volume, and this is very interesting. The volume is 200,000 shares by 922, but when you look at the time and sales, you see that 200,000 shares at $54. That's one single transaction. Between one institution to another, and then the rest is nothing. It's only 3,000 shares that the market is extra. You don't want to be in that. You don't want to be these guys because there's only one big transaction. That's why it hit your scanner. If this guy wasn't there, the SPP wouldn't really hit the scanner. So you have to be really careful to always look at the price action in the pre-market. So another question that might come up is, okay, I don't have trade ideas. I don't have access to a Gappers watch list. So what should I do? So there are a couple of ways that you can get away with that. The first one is if you're using Dust platform or any other platform, they usually have a top list that gives you a free scanner. So all of you who use Dust, that there's a top list and there are 3 columns: Nasdaq Active, Nasdaq Gainer, Nasdaq Loser, and then the other exchange, New York NYSE, New York Stock Exchange, and American Stock Exchange. So if you go through the list, all of the stocks that in that particular they hit the scanner, somehow they are in one of these columns. They're either the most active, they're either popped up or popped down. There's somehow, if you see in this example, I actually marked the ones that are available here. So you just have to have a more difficult job to go through each of them one by one. But you can, if you have time, you just go through all of them and see which one is potentially tradable. So you don't need to 100% have the trade ideas to really find that. You just have to, do a little bit of more job. Or if you are part of a trading community, just see what moderators are looking at, or ask other traders, what are you guys are trading? Because you as a trader, you really want to trade what other people trading. Or there are some websites, Finviz and Benzinga, they also freely, publish some of the, hottest stocks. Or sometimes the Twitter you can find, or stock tweets, or other social media you can find. But you want to have a consistent way. That's why we pay for trade ideas. Yes, it's expensive, but as a business, you really need to have. What if one day you woke up late and you don't have time to go through all of this list, or there's no information on Twitter, or I don't know, or if you're not part of any chat room, so how do you want to know that? It's good to have that. That's why. But it's not really necessary. It's good to have. Another thing that we should mention, that we don't trade foreign companies. The companies who are actually trading in other exchanges around the world, or they're directly affected by currency exchange and foreign forex market, we don't trade. They're like Toyota Motors or Fiat Chrysler are examples of that, because every single day you see these stocks are gapping up and down. So Toyota Motor on a normal day, the stock is gapping up and down. Why? Because the USD Japanese yen exchange rate is changing overnight, and the stock is being traded both in Japan and in the US. So when the Japan market is open, it affects the value of the company when the market in the US is closed. So that's why you always see these gapping up and down, and it's very hard to find any level on these. And usually the companies who are not really they're not really traded in the US, they usually don't have a lot of range. So we would stay away from these kind of stocks. All right, so you might ask, okay, I have from 7,000, I have 5, 6, 7 watch lists that is really good pre-market price and volume. What's next? And you still have 15-20 minutes to the market open. So what is next? And that is the part that we are going to discuss. And now you have to find the support or resistance level. But before we getting that, is there any question from the chat, from the classroom? Thanks, Peter. Peter actually shared. Was it? Did you guys understand? Excellent. I'm glad it's clear. All right. So Shubi is asking how many stocks I recommend we should watch. I mean, it depends on how many screens do you have. I personally don't like anything more than 5 or 6. It's 3 to 4, 2 to 3 is usually the best. 1, maybe it's not too much, because sometimes not all of the stocks that you find are really giving you any opportunity. So it's not good just to look on one stock, because what if you don't find anything? So you always want to watch another stuff. And depends also how many screens do you have. So you see my trading station in the back. I don't know if you guys can see that. So I have a bunch of, let me see if I can show that to you. So yeah, so there are a bunch of as you see that there are a bunch of screens that I have. So I have the opportunity to look more, but some people don't have it, so you're limited on that. But I would say don't go more than 4 or 5, because even if you have a lot of screens, you lose attention. So you have only enough focus and attention. All right. So, okay. So next part. So now imagine you have the stocks. All of them have the good volume, and all of them have the good price action. There is no buyout, or there is no garbage in there. Now we want to find support and resistance, because as a trader, you need to have levels. How do you want to define profit target? How do you define stop loss? So you need those levels. And this is what we discuss in this part. I personally use only horizontal line price. And this is something that I need to clarify with that. I personally use only horizontal line support or resistance. I don't use trend lines, because I think they're confusing. I know it's very standard. I know a lot of people are using them, but I personally don't have time and don't have any interest to use trend lines because market remembers price. Everyone remembers that Apple was $210 or Snapchat was at $27 or Baba was that price. Nobody remembers pattern. Everyone remembers market, computers, institutions, they remember the numbers. And that's why horizontal lines make sense because they represent a number, $19 or $20 or something. But the trend lines, to me, they are really subjective and open to self-deception. I know there's a lot of traders that might disagree. With all due respect, that's the method that I have. I mean, you guys can definitely benefit from different chart patterns. I know there are, ascending wedge, descending triangles, and these kind of things, but I personally don't use them because I think they're really confusing. I mean, I was watching, some video and other traders that are trying to find levels, and this is just a screenshot that I got from their video. And what I see was it's very confusing. I mean, this is the pre-market analysis of some of the traders, and these are all the levels that they put as a potential level. Well, this is confusing, and if you put a lot of lines, eventually something hits one of them. How do you want to really make a plan out of that? So that's why I really stay away from this kind of very ugly and very busy and confusing lines. And again, this is my opinion. This is the way. There are more than one correct way. There are millions of correct way of trading. Some of them with trend lines, some of them without them. But just is what I'm trying to say is my style is really not to have a lot of confusing trend lines. And again, remember, these are all subjective. And this is not for my work. This is a screenshot from really good traders that they trade like that. But I really don't understand how to do that. And again, they are they're subjective. They are really self-deceptive because if you're in a good, look at the same chart and say, if you're in a mood of buy, you want to go long. If you have a bias based on the news or based on the market or based on price action, you can just draw this line and say, market is in an uptrend, let's go long. Someone else is in a mood of short selling or selling short, and you look at the same chart and then draw, trend lines. This is a downtrend, let's go short. Of course, these are very simple examples. They're really not true. But again, what I'm trying to say is, if you really want to go long or short, you identify or you recognize what you really want to do. That's why they're really subjective. They're really self-deceptive. There is a very risk of self-deception in trend lines on that, or even chart patterns. Head and shoulder, reverse, cup and handle, harami, and all of those stuff. I personally am really not taking those very seriously. So I use only horizontal support or resistance, and those are the lines that it's very easy to recognize. The support is a level the buyers are jumping in. So if the stock is dropping, you have a line that buyers are start jumping in. Either the price holds here and then bounces, or sometimes it holds and eventually cracks that support. But that is a level that buyers are jumping in, or short sellers are start covering. If you're short here, you don't want to cover too early. You want to cover right at a support because that's the maximum profit. Resistance is the same line. It's the same line if the price comes from the other direction. Resistance is the price that sellers and short sellers are jumping in and dump their position. The price might hold a little bit, it might bounce, or it might crack that and goes higher. But that's the moment that really the balance of the power changes between buyers and sellers. But what are those levels? How do we find that level? That's a very important question. So there are two types of levels that we use. And again, this is our strategy. There are definitely more than that. But this is what we do. And so far it has worked for me and for some other traders. But definitely you as a new trader should go and learn about all of them and combine and see what kind of strategy you want to adopt. There are some levels that automatically a platform DAS trader would find for us, or even if you're not using DAS, other platforms probably have that. There are some important levels, and there are some levels that you as a trader have to go and find them by evaluating the pre-market and daily chart. And we talk about both of them. So the first one is easy because just automatically every platform will get that for you. But the second one is just requires some practice and experience because that's what you should do and you should actually go and find. So what are those automatic ones? There are 5 levels. Previous day close is the most important one. Yesterday high, yesterday low. We call them Y high and Y low. 2 days ago high and 2 days ago low. These are the 5 levels that we want to pay attention on that. So if you're using DAS, we do have a price study called Price Marker. In the Price Marker, you can actually identify yesterday low, yesterday high, 2 days ago high, 2 days ago low, or you can just add more. You can add another price marker and just add into that. And you can change the color any way that you want. I personally don't change the color, but it's really, really important to have those charts, because sometimes you would be surprised. I mean, this is an example. VRX was trading, market opened. I didn't do anything. I had these 2 lines, 1656 and 1676 from the price marker. I didn't do anything to find these levels. They were automatically on my chart. And when the market opened, and as you see, these level really held up. And later in the afternoon held up as a resistance. So this turned out to be a support, this turned out to be resistance. Even in the market, it bounced back a few times from here. And, even bounced back from here. So as you see, there are potentials, reaction to that level. So it's good to have them. I'm not saying that how to trade. I'm not saying that every time it hit that support, go long, or every time it hits the resistance, go short. No. I'm not teaching any strategy yet. I'm only teaching how to actually have them, because that's the first part. You have to identify meaningful and important levels on your daily chart. Let me give you more example. So this is a Snapchat. So Snapchat on February 20th, 2018, on the day before 16, the yesterday low was something around 1960, and yesterday high was but I'm saying yesterday, I mean previous trading day, because that was probably a long weekend or something. The next trading day was at February 20th. And as you see, the stock gapped up, come down, bounced back, and as you see, never really cracked that level. So this is a trade that I took actually. I went long, I sold toward this level, and then another ABCD pattern, I went long, and you see this is the level. This is the same level that you see here. This is the same level. The stock never bounced back, and this is not a coincidence. There is a very important level support or resistance here. Again, I'm not teaching you why I went long or why I went short here. That's not part of our discussion. But having this meaningful level is very, very important in your chart, in your trading. Example, this is X. X, it was in a trading range, then it gapped up. And then yesterday high was around 44. 2 days ago high was also around 44. When the stock gapped up, sold off all the way up to this level, these two, 44, 44.10, these two yesterday high and 2 days ago high. And as you see, the stock never really cracked that level. Tried to go down, but couldn't, and eventually bounced back. So that's a very important support or resistance level. Someone might say, oh, why it's not accurate? We discussed that later, that these levels are areas. They're never accurate to the penny. So when you see something like that, always give 5 or 10 cents give and take, depending on the price of the stock, as a potential. As you see here, there's a huge nice bounce back from here, come down here, struggled in this level, and eventually bounced back in the afternoon. More examples. Previous day close. So MNK on January 19 gapped up. Previous day close was at 46.52. Stock at the open, so the market opens here. Stock sells off all the way up to the previous day close and then bounce back going here. What is that 46.52? This is not magic. This is the previous day close, January 18, 2017. I already had that in my chart. Another one, CUDA, stock gapping up to 25.60 and 23.81. I had that on my chart. I didn't do anything. What is that number? That's the previous day close on January 9th, 2017. You can actually color code them to actually see, which one is previous day close. I have them color coded. The stock is selling off heavily, bounce back. You can't, in the morning session, can't really crack the previous day close, comes up, false breakout comes, and even in the afternoon cannot crack that, and eventually closes above that. So I'm not teaching any strategy yet. I'm not saying that every time he touched this one go long, or every time went below that go short. No, I'm just showing to you how to have this, because this is important. More examples. MU. This is a stock that we trade a lot. 51.37. That's the previous day close on August 12. Market, stock gapped up, sold off, never loses the previous day close. Goes up, does a lot of chopping up and down, comes back, bounces back, and then comes down all the way to the close, and it really pretty much closes right at around that time. So never really loses that previous day close. So that's really important. And as you see, the volume is somehow higher when the price is coming toward that previous day close. But why? Why previous day close is so important? Because the close of a price is the number that institutions and market makers and professional Wall Street traders agree on the price when the trading day ends. You know, this is JUNO. This is a stock that has gapped up, you know, and it closes at 30.75 in that day. It means that nobody is willing to hold this more than 30.75. When you go back in there a few times, you see that 30.75 is actually very important. In the last few weeks also rejected that level. It means that the company isn't worth more than 30.75. Somehow nobody is willing to hold anything overnight more than that. And they tried in the past, it rejected. I mean, this is not a coincidence. That 30.75 has some meaning. What is the meaning? I really don't know, but we know that professional Wall Street traders and market makers and institutions agree on the price of the JUNO on that particular day at 30.75. So these are the levels that we have. So yesterday high, yesterday low, 2 days ago high, 2 days ago low, and previous day close. 5 levels automatically on the chart. You don't need to do anything. You just put it on, set it up, and then you have it. But there are other levels too. Now you as a trader have to go and find that level. So pre-market levels, moving averages on 5-minute chart and a daily chart, which we later talk about that, and extreme prices on daily chart when the price is bouncing back. We'll discuss that later. You know, the more level that is, you know, the price comes to the price, you know, on a daily chart, you see there are some areas that every time the price goes on a daily chart bounces back. We discussed those stuff here. And also the all-time high and all-time low, which we added later. And remember, these are the area, could be a few seconds up and down. You know, I know that traders love to have it down to the penny, but usually you don't get them down to the penny. These are the areas. Is there any question, guys? At this moment, if there is any question, feel free to type it in. Is it clear, guys? Am I going too fast, too slow? Can you follow? Excellent. So we'll continue that. So pre-market levels. So you have NVIDIA gapping up, you know, 2% in your chart. And you know, look at the pre-market. You see the stock has the low of the pre-market, and the high of the pre-market is somehow around here. And then when the market opens, what you see here is the low of the pre-market is actually holding as a potential support, and the stock is bouncing back, goes up on a pullback, tests the high of the pre-market as a potential support, and then eventually moves higher. Do you see? Where did we get that 149.89 and 148.83? You know, give and take. These are the high and low of the pre-markets. So having a very clear high and low of the pre-market is really, really important. So every time when you look at the Gappers watch list, if you like the price action in the pre-market, always make sure to have roughly, again, not always accurate, roughly, you know, the high and low of the pre-market. It's really important. AVEO, this is another example. You know, this is a real screenshot that I took. So this looks like a low of the pre-market around 290. I mark it at 295, but I probably make a mistake, something in between. This looks like a low, and the high is something around 320. The market opens at 930, and as you see here, the stock sold off and then bounced back all the way up to 320. And then sold off back to the low of the pre-market at between 290 to 290, 295 to 290, and then bounced back, went up. So do you see that this movement for a stock, even this is a lower price stock, $3, but these two levels actually made a very, very important very important fluctuation. Support or resistance. All right, so pre-market levels. What else? Moving averages on daily chart. That's another category. Moving averages on daily chart, if the price is near them, can be potential support or resistance. Not always, but a lot of times you see that, especially on the big days. So AAOI, you know, closed at 20 below 21, gapped up at above 23, and then it sold off during the day all the way up to this area. There are a bunch of levels: 9 moving average, 20, and 50 moving average. They're all here. So there's a potential resistance here. Support here. The price comes here and then bounces back. Even when you look at the daily chart, you see that sometimes really beautiful bounces that you see on a daily chart, and these are really happens on a moving average. Sometimes it cracks, you know, in this example it does crack, but a lot of times you actually see a very beautiful, nice respect. Another example is GLPG. GLPG closes at 73. The next day gapped up at 83. During the day sells off all the way up to 78. So what do we have? 9, 20, and 50 moving average, and eventually bounces back. You know, there are USG. USG, the stock, as you see, becomes a stock in play. Bounce from 20 moving average. This bounce from 200 moving average. Bounce from 200 moving average. And as you see, there are really bounces from 20 moving average here as well. So, you know, these are not really coincidence. People look at the, especially the higher the moving average is, like 200. This is an example of a GLPG that we discussed. So GLPG, you know, as you see, gapped up 14% a day at $84. But during the day, this is actually a trade that I personally took. You know, you mark this, you know, yesterday low, yesterday high, 2 days ago low, high are there, but they're really far from the current price action. They start gapping up at 83. And, you know, if you market, you know, these three potential area, if you go short, you probably can have a really nice profit target all the way up here. The blue line is the VWAP. Blue line is VWAP, and we don't have VWAP on a daily chart. That's why it's inside. So we don't really pay attention to the VWAP on a daily chart. Because unless you anchor VWAP to a certain area, the VWAP really doesn't have any meaning on a daily chart. Some people use anchor, so they start from certain point and then they bring in new moving averages. That's called anchored VWAP, but we don't use that anchor. Swing traders, some swing traders use that. Another example, so JD, so that's an example. JD gap down, so you know it closes at 45.50. Next day gap down to 44, and I come here and I say, okay, what's the potential support or resistance? I see 42.17. This is a moving average, 50 moving average. I marked here. There's another one here, 45. So I marked these two, and even the pre-market, the stock is a come and bounce back at 42.17. Even in the pre-market, before the market opens, bounce back and goes back up. So someone might say, okay, why it didn't hit this 42.17? The answer to that is because, again, these are potential support at the area. They're not really down to the penny. So Danny is asking, so there's a question on GLP. I think you mean by GLPG. So the question is, the stock gapped up. Why did you go short? The reason for that is that's not what we do. We don't wait for we don't go long a stock that gapped up or go short that a stock gapped down. No, we always observe the price action, because when the stock is gapping up, there's a lot of things can happen. There's a lot of profit taking can happen. You know, there's a lot of investors that say, oh, stock is gapping up 15%. Let's dump our position. Let's take profit. Or a lot of shorts might have to cover. So, you know, you never know really what's going to happen. The stock might go up or go down. A lot of investors might get out. A lot of new investors might get in. There is a lot of shorts that got to get squeezed. There is a lot of profit taking. Same when the stock is gapping down. When the stock is gapping down, a lot of shorts want to cover for profit. A lot of investors might say, oh, that's a good deal. Let's buy that. You know, it's really cheap. You know, they see opportunity to buy the stock. Or a lot of investors might panic and say, okay, I'm going to cut the losses. I'm getting out. You know, there's a lot of forces that at the same time can go, and you never know. That's why we always look at the price action for first 5-10 minutes to see who is actually in control of the price. This is another example, IONS. So this is the stock gapping down. So the stock is closing at 62.50. You come in the pre-market and you see the price in the pre-market is at 56.25. So me as a trader come and look at the daily chart and say, that's interesting. There's really no important level except 61.56 is a 9 moving average. 58.84 again, give or take, is potential level, and 50 simple moving average around 54.24, give or take. And I don't know what's going to happen in the day, but I know that the stock in the pre-market is around that range. That's actually happened in the market. So we'll take a look at it, and you see the stock bounced back from 20 moving average all the way up to 50 moving average. And look at the heavy volume, completely higher than normal trading volume because of this gap down. This is what we discussed in the earlier section. And this is a trade that I took. I personally at the open, so I waited for the first 5 minutes. and I saw sold off, came back up. So I really didn't like this price action because I was kind of, didn't really want to go short. The stock did drop, bounced back from the VWAP. I saw the weakness, I went short, and as you see, we went all the way up to this 54.21. And what was that for? $474. But what is that 54.21? That was the where did you get that? Oh, here you go. That's the moving average. So as you see, I had this. If I didn't have that level, where do I know I need to cover? Do you know what I mean? That's the whole point. If you didn't have that 54.21 from daily chart, how would you know? How do you define your risk to reward? Because you don't have any potential reward. If you don't have, you can define your stop loss. The stop loss can be above the VWAP, but what about the profit target? So you need those levels in your daily chart. Otherwise, you are shooting in the dark. This is another example. This is MU. So MU, gapped up a little bit, 62, sold off all the way up to 60.02. And if you had this 60.02 as a potential level in your chart, again, if you catch that around 60, you see the stock is bouncing back all the way up to 60.02 and then bouncing back. This is not magic. This is the good analysis of the price action on a daily chart. Again, you might say, how do I know that this is the low of the day? But from the daily chart, you see there's a potential. This is a 9 moving average that is coming. What about this one? What about this one? Yeah, you could put there, but that's probably too much of a stretch. From 62 is very unlikely that MU really drops to 53. So this is a more reasonable profit target if you really want to take a short trade out of that. Another example, GTN. So as you see GTN here, so bounce back from this 200 moving average. Just another example that moving averages on daily chart can be potential support or resistance level. Light, that's a stock that we traded in the past a lot. As you see, potential, I just wanted you to see the potential. This one it popped up a little bit more, but these are really down to the penny resistance. This one is also a resistance on the moving averages. This one also another one. So these are really, really important. Specifically, it's interesting in this day, because these days are really normal trading day. You probably don't want to trade that. But in this specific day, I think it's in, I think in December. Yeah, I think this is in December 13, 2017. The stock gapped down heavily, so closed at 51, opened at 45, and then went back up and bounced back from that moving average. So that's really something that I wanted to really pay attention to that. What else? This is MU. Oh, that's a good example. So MU. So this is what we do. So MU closed at 47.50. And then the next day gapped up at 48.48. So that's the price in the pre-market. The market hasn't changed anything. It hasn't done anything. So gapped up at 48.48. Potential 49.08. What is that? This is the moving average, 20 moving average. That's 9. You can now also mark this one as well. And then there's another one, 49.08. The market opened really strong, went up, and as you see, never really was able to crack the 49.08 and eventually dropped from that. So that's an example that I wanted to mention. Again, the date, so May 7th intraday. So I just wanted to show you what's going to happen on a daily chart. Yeah, SB is asking a very good question. So I really like this question from SB. Yes, you can. So the answer to that is, so for example, SB is asking, can we just go and find the level around here, find the level around here? Yes, you can. But remember, MU has an average through range. You can have maybe up to 2 ATR and see. There is really no point to go and find levels down here. Because what's the ATR of MU? Maybe $2. So maybe up to $2 you can actually, maybe $1 is the ATR. Maybe you can have up to $2-3 because even in a big day you have $4 maybe up and down. So the maximum that you can actually have on a big day maybe $2-3 up and down. So that's really the maximum that you need to go. You really don't need to go and find levels down here or very up there because it's unlikely that price goes up there. That's a very good question, SB. Yeah, well, that was a good statement. And then another one. Oh, okay, so moving averages on daily chart, sometimes you can actually see on a 5-minute chart. So the market opens, so the 9:30, this is the market opens, and, just the consolidation. I went short. Where's my cover? I cover at this 200 moving average in a 5-minute chart. Yes, I had some level down here and down here, but they were really stretched. Stock that's 1575, 1525, that's a really good profit. So I'll just cover that at fault. So that's just an example I wanted to show you. The higher the moving average is also good for, this is JUNO. I went short, and 200 moving average on 1 minute chart was also a potential. As you see, drop, cover some, covered some. I really wanted to crack it, but it didn't bounce back for 4 minutes. It struggled at 200 moving average, especially on 200 moving average, and bounced back, and I got out the last piece. The higher the moving averages are usually the more powerful. So 200 moving average is usually more powerful than 50 more than 20 is more than 9 moving average. Higher the time frame, better. So I would pay attention to the daily chart and the 5 minute and 1 minute chart maybe, but sometimes 200 and 1 minute chart, I'll pay attention to that. All right, so these are the moving averages. What about other ones? So extreme prices on daily chart. So this is the tricky part. So we're looking at the extreme prices on daily chart when the price reverses the direction. When it comes down, bounces back and goes there. The price must have a clear bounce from that level. If you're not certain, you're not sure, ignore it. It's probably not support or resistance. The levels have to be, catch me by the face, that type of obvious support or resistance. The more a line touches those extreme prices, the better. Give more, value to the support, because it means that there are more other traders also looking at the same thing. And remember, support and resistance are actually an area. They're not exact numbers. 5 or 10 cents, depending on the price of the stock, should give it. For a stock that is $2, 10 cents is a huge range. You probably want to have 1 or 2 cents. But for a stock that is $50, maybe you can give 5-10 cents up and down for potential area. And you always look at the recent data. You go back in time as much as possible to see the support or resistance in that area. Don't go back to 1994, because if you have any data, in the last few months or last few years, stick to that. Ignore those times. But if you don't have anything, just go back as much as possible and see if you can find anything or not. But really always recent data are more important. Examples. So Michael Kors. If I just randomly look at this daily chart, if I want to find levels, this is a really big bounce with heavy volume. That's definitely a level. And 4211 is also nice, because I like that, because there's a big bounce here, big wick, good volume, big bounce. And there is also 3 days that is struggling in that level. So these two levels are really obvious in this range. I mean, this one is probably a level 2. This one is probably a level 2, but these two, I really like that. These are really obvious. More examples. Solar City. Look at this daily chart. And if I want to find some levels, these are the levels that I find. And I actually put an arrow why I made this. So because huge bounce from here, price comes down and goes back up. I don't put this one in because the price really didn't change the direction. I mean, it goes up here. Yes, it does bounce, but the next day also goes up. That's why I really didn't pay attention to this week, because price didn't change the direction. This one is a nice one. This one might also be one. I probably should have marked that. This is obvious. This is probably an obvious one too. I probably have missed that too. And these two are really nice. This one is nice because there's also a bunch of bounces from here too. And these two are also really bounces. And these are really, really nice, clean daily charts. I actually like that. So example. So HD Home Depot. So a stock was trading at 153. And the pre-market gap down at 147. So now you want to find the level. So this is the price in the pre-market. So is there a really point for me to go up and find the levels here? Not really, because I don't think the stock really goes and trades in that 160, 161. So I have to find, probably it starts trading around in this range. So what I should do is I really should go and find it around that area. So if I zoom in that area at 147.3, 147.03, so we have this moving average, so we can definitely put 142. Still, this looks like a stretch, but I can just mark that. And then I go back in time until I see some recent data. And these are the data that I really like. So I just have to focus on here. There is no point for me and pay attention to, find levels up here, because the stock is at 147 now, gap down. There's no point really to go up there. So if I zoom in that area, I can just find some levels. These are the levels that I would say 149.50. So these are a bunch of bounces. And again, these are areas, especially it's a higher price stock. So you have to give it 10 cents, 15 cents room. So these are the areas that I personally want to look. Especially I want to look at 149, 149.90. That's a very obvious bounce. Bounce. There are a bunch of bounces from here, and there are 2 clean bounces. And again, an area. If you look at the daily chart, okay, what's going to happen that day? As you see, the stock, these are the levels that we had. And as you see, 141.91, that level, as you see, never really cracked that level. It was a really nice opening range breakdown all the way up to this level. It did bounce back once from this 148.33. It did also bounce at the open in the first 5 minutes from 149.04, but really needed to crack the VWAP. VWAP is the blue line, but eventually really cracked to that. And look at the volume. The volume is also significantly higher when you hit that level. Here also the volume is somehow higher. Is this clear for you guys? How did I find these levels? I mean, this is coming with practice. So the black line, it means this is a doji. So the black means the candlestick is neither red or green. It means that's just the open and close are at exact price. Another example, this is MNK. This is a MNK. I'll get to that SP. So this is MNK. So a stock, imagine it closes at 16. The next day gapped up at 1866. So if I want to find the levels, so 2061 is a moving average, 1753 is a brown moving average. There is also a back bounce from here. There is also one bounce from here. I like that. 2107 is interesting because there's a bunch of bounces from here. 2203 is also really clear bounce from here. There's also a bunch of bounces from here. And then 2376, these are 2 bounces from here. But these are the levels that I put in the pre-market. I have no idea what's going to happen, but these are the levels that I want to make into that. And let's see what happens. This is the day. So it goes all the way up to 2063. In the first 5 minutes, opens really strong, goes up all the way up to 2203, which is this level that we found. So it goes all the way up here, bounce back, and goes all the way up to see how close it goes there, and then it bounces back. I actually personally traded that stock. So what I did was an opening range break up. So after I waited for the first 5 minutes, I won long, and I start selling for the crack of 2107. Again, remember 2060 to 2107, that's 50 cents. 50 cents is really good for a stock that is $20. So it just popped up and I started scaling out all the way up to 2203 for $1,800. That was a decent trade that I took. And later, it bounced back. I never touched that because I made a decent money on that. So SP is asking, what about intraday levels? Yes, you can. You can. So for example, you're coming in the afternoon and you didn't have this 2203 level, and now you want to come. It's obvious there's a level and there's a level here. So you can look at the price action, the intraday, and you can actually find those levels. So you come and see, oh, it looks like this level and this level. Sometimes you don't find these levels in the daily chart, but they show themselves intraday. It's good to mark them. If they're really clean and clear, it's good to actually have them. But I personally don't use pivot points or Fibonacci lines. But again, what I'm trying to say is there is more than one correct way. There are many ways that you can trade. This is our style. And I like to keep it simple. Really, simplicity is something that, because I really believe traders are taking trading more complicated than it should be, because it's a difficult career, and people want to overcomplicate stuff. They think that by just adding more mathematics into that, they can actually get an advantage, but it's really not that complicated. All right, we found about that. What about all-time high and all-time low? So Wall Street and traders are look at the few other important levels too. So these are very famous levels: all-time highs, all-time low, 52-week low, and 52 high. These are emotional levels too. For example, you're an investor, you're holding 5 million shares of Apple, and then Apple hits the new all-time low. Then that's the very, or maybe a 52-week. In the last year, it has never been low that much. So that's an emotional level. Sometimes it's a strategy. The fund managers say, okay, if this stock hits the new low, dump your shares. The stock is garbage and you don't want to stay in there or whatever for any reason. So it's really, really important also to pay attention to all-time highs and all-time lows, 52-week high and 52-week high. And the scanners also have that. In Trade Idea, you can actually have the 52-week low and 52-week high, all-time high and all-time low. And these are really, we have examples that they show themselves. Let's go through examples. So ZGNX is a very interesting example. So what we saw, the stock was gapping up at 36.50 on October 2nd, 2017. I wanted to check it out and see what is this ZGNX. I mean, I went to check it out and I saw that it had a really, really nice day yesterday. So that there was a really nice day at 35. The next day gapped up at 39. But I had to go back in time. I really had to go back in time. This is a weekly chart because I just wanted to put everything in the chart. Back in 2014, I saw that there is an all-time high here. In an all-time high was at around 41.47. So that was the all-time high back in 2014. So again, this is a weekly chart because I really wanted to put everything in there. If it was a daily chart, it would have been really ugly. So as I see, there's a 41.47. So let's see how actually the stock traded. The next day, the stock is traded like that. So the stock opened very strong in 5 minutes, never cracked the 41.47 and then bounced back. So if you were watching this is a double bottom. You could actually short the stock with a stop loss above the all-time high and then down all the way up to this VWAP. And look at how beautiful the moving average hold as a potential support. So all-time high, all-time low, 52-week low, 52-week high, also really, really important to have. Sometimes in the chat, I say, oh, I really like the daily chart. I want to trade that. And I don't like the daily chart. People are asking me, what do you mean when you say there's a good daily chart? I just want to show you a bunch of examples that what is a good daily chart and what is a bad daily chart. So this is an example of Apple. So this is a daily chart of Apple. The stock has sold off. I think this is the November or December. I'm not exactly sure. 2018 comes down and then bounces back. And now in the pre-market, we are trading at 190. I think this is November 2018. So the stock is being traded at 190. I really like the daily chart. Why? Because we are really close to some very important levels. So what are those levels? The 2 days ago low, it's here. 2 days ago low also, yesterday low is here. Then we have 2 days ago low. And then we have the 52-week low. So, and on the long side, we have a lot of resistances. I like that because I think there is a potential for a sell-off. We don't know, maybe it goes up. But if it shows weakness after 5, 15, 20 minutes, there is a potential for a sell-off to the 52-week low. So there are heavy resistances above 190. So but at the same time, there is really, really nice. And remember, the stock has gapped down. That's another thing. The stock closed here, but at 194. But next day gapped down. So the stock gapped down. So weakness is already in there. You see the weakness. You feel the blood. You smell the blood. And then you see there's a level here. There's a level here. If this stock comes down, would you buy as a buyer? No. No buyer would jump in. No investor would jump in. They wait. They wait until see what's going to happen here and what's going to happen at the 52-week low. I mean, if I'm a hedge fund manager, I want to buy 200 million shares of Apple, I would never jump in at 188. What I want to do is I want to buy at 186, or if it cracks that or something like as a potential support. Okay, let's take a look at that. Here it is. That's the daily chart. So stock actually, oh, that's a storm out there. So that's actually stock really turned out to be weak and cracked the 52-week low and 2 days ago low and actually closed at 184.90. So that was a really good short. So potential weight, these are the if-then statements. You see, okay, if the stock shows weakness at the open after 5-10 minutes, I go short for a potential crack of 52-week low. More examples. So again, this is another example. JD. If JD was here, I wouldn't like it because it was really messy inside a congested area, a lot of moving averages and levels. But JD has gapped down. Now the price is at 22.32. Price was at 23 the day before. Now it's gapped down at 22.32. I really like that. Why? Because there's a very important 21.70 here. There's a very important level here. And this one is actually a 52-week low too. I mean, if you go back, I didn't show the whole year, but if you go back in time, you see that it's actually, this is a 52-week low. So I really like that. And even the pre-market, this is interesting. This is the pre-market high and low. Even in the pre-market already bounced back from that level. So it shows that it actually, there is really something into that. So that's why I really consider the fact that I want to go short if this shows weakness. And look at how much resistance you have on the daily chart on a long side. So, again, if you look at it, next day, not only the next day cracked that 27, so this is a level and this is a level. So not only in that day we cracked that, but also the day after we also cracked another one, went up into the all-time low. So this one was a 52-week low, but if you go to the daily chart, the next day closed here, the next day even closed lower. This is, now everyone smelled the blood, so people go short here. So 52-week high and low just by looking at it on a daily chart. I don't think that Dust platform has. I might be wrong. Maybe Robert or other people can mention that. Do we have any indicator for 52-week high and low? So far the only way that I know, I just look at the daily chart, between 9:15 to 9:30 and see if there is any high or low or not. But I could be mistaken. Depends. Maybe someone can. Oh, Peter is getting it from finviz.com. So again, that was the information. What makes a daily chart good? What makes it bad? This is for a stock in play. This is another chart that I wanted to mention that to you. I really like that. So AMD was in a channel. So there was a channel between AMD. It was really choppy between a channel, but the next day is gapping up. So as you see, 22.10 was the level that bounced back. Eventually we popped up above that. And as you see, I really like that because now we are in an area that there is room for a movement. And as you see, in the next day, we opened here and we went all the way up to 23.52 on this bounce from 50 simple moving average. And I like that because the volume also come in. But if something in here on here, I really didn't like that because it's just in a congested area. But if it cracks here, now I really like it because we can move to the downside or to the upside. You really want to have a breakout from the range. So AMD is trading in this range, and it was really bothering me that the stock is being traded in that range. But as soon as it popped up above 22.10, that was a really nice move and clean move toward this moving average. Even if it were popping down here, even if it was really cracking down here, it would have been a nice short or nice long back. But I really wanted to get out of that range. So what we discussed so far as a summary. So how to actually build a watch list. We look at the gappers watch list. We look at the fundamental news. We check the pre-market. We find it, we look at the daily chart and find the trading levels. And the trade is the last piece. So we need all of this information. A lot of people want to wake up and start trading, but it doesn't work that way. You really need to go through those steps. This must be a routine. Like a surgeon who wants to do a surgery has to go to the change room, look at the x-rays, talk to the anesthesiologist and talk to the nurse, get everything ready, wash the hand, and then go. You can't just wake up from the bed and just go start doing the surgery. So these are all the procedures that you have to do. And a lot of people underestimate this process, and I really want to make an emphasis on that. So let's go through one example. Let's go through one single trade that we did. So we wake up on February 15, 2018. We come and see Teva is gapping up 9.3%, 2.5 million shares volume by 9 o'clock. That's pretty good. The stock has a really nice ATR for a stock that is $20. $1 range is really nice. Take 1,000 share, $1. That's $1,000. Not bad at all. So I'll look at the Teva. And what's the news? Go to Bloomberg or other stuff. Teva surges as Buffett's investment stocks hope of recovery. So that is the news that comes in that Warren Buffett, Berkshire, invests $350 million in this company. So that's the news because Warren Buffett is a big investor, is a big hedge fund. So they are investing in this company. It means that there must be something. The news came out and then the stock gapping up. Everyone is coming in because everyone wants to piggyback behind Warren Buffett. So that's a really good, interesting news. I would accept that as a good fundamental news. What about the daily chart in the pre-market? So at 6 o'clock in the morning, you see the stock is gapping up 2080 all the way up to 2120. That's pretty good. So, that's a very decent pre-market. I really like that. So it gets a check mark from probably a 10 out of 10. That would be a 7 out of 10 or something like that. So I like that. What about the daily chart? What about the daily chart? By the way, this is wrong. This is not the previous day close. By the time that I took the screenshot, this is not the previous day close. So ignore that line. So the previous day close was around 90 or something. So ignore that line. So what's going on? We come here and we see the previous day close was at around 90 something. The stock is now gapping up at 2072. That sounds like a very interesting daily chart. Again, that's what I'm saying, that daily, I really like the daily chart. So let's find some levels on the daily chart. That's a good practice. I would say this is a very good daily chart. So what are the daily charts that I find? 1776, yesterday low, 2 days ago low, I already have that. Yesterday high, 2 days ago high. The previous day close, I already have that. 1973, a moving average. 2156, a moving average. 2186 is bounced from this level. 2263 is bounced from this level. What is 2024? 2024 to me looks like a bounce from all of these levels here. So it looks like a bounce from all of these levels. So I have these levels, but the price, but it seems like a very clean move around here. So what I do is I start looking at the price action. So candlestick. So the high of pre-market also looks like a high of pre-market around here. The stock sells off, bounce back in the first 5 minutes. Opening range. I mean, this is what we discussed in class 4. I went long. Popped up, high of the day 21.26, sell some, all the way up to this 21.56. And the last piece I'm getting out 21.56. From $21 to 21.56. Take 2,000 shares, that's $1,000. That's a really, really good profit. And here it is. And on a daily chart. So a stock popping up, $21 all the way up to 21.56, which is this daily chart for a decent profit. So I just wanted to walk you through this step by step. And again, remember guys, I'm not teaching any strategy yet. I'm just telling you what to trade and how to actually find the support or resistance. The strategies come in class 4. And yeah, that's it guys. Well, thank you very much for coming. And I know it's late in the evening. If there's any question, I'm happy to answer that, guys. Is there any question? Was it clear, guys? Did you understand that? Feedback, recommendation. So Rishi, it would be so the recording would be available on the Education Center, and we would be probably update and teach that again in next year because we are already December 17th. So pretty much that. So come tomorrow morning, come into the chat room early. Carlos starts the analysis at 8:30 in the morning. I'll come at around 9:15 on the Eastern time, and then we we practice finding these levels and if-then statements and everything. Have a good day, guys. And for those of you who are watching us on YouTube, I do hope that you enjoy this lesson. If you like that, please share, please like, comment. If you have any question, we come and we answer every single, I personally come and answer every single comment that you put on YouTube. So I really appreciate that. SP, the pre-market levels, you have to find it by yourself. Those are not automatic. All right, guys, have a good day, and I'll see you tomorrow morning in the chat room, guys.